Welcome to the Delta Business Bite. Tiffany House, a chartered advisor with the Gift Planning Institute, explains various options for minimizing the tax consequences when selling your business. Please share an example of a charitable planning tool and explain how it can be useful if you take the time to plan.
Well, thank you. I really enjoy looking at charitable planning tools to help offset the tax consequence of business sales. There's some great tools out there, and we're going to only walk through one of them today. But there are tools for each individual type of asset that you might have that can really help out. I like the charitable ones because I like giving back to our community. I find entrepreneurs are 9 times out of 10 also very charitable, but there are other strategies, opportunity zones, and things like that that you can take a look at using. But today we're going to talk about a charitable remainder trust. And I like charitable remainder trust because it solves a lot of different tax issues that can happen. So I'd love to just walk through a quick example with you of a charitable remainder trust. So with this example, we're taking a $2 million business, and you can add zeros here or there or adjust up or down. This is just a nice example of how the trust works. So we have a $2 million business, but I never like to take all of something and wrap it up into a tool because I think you get the most benefit when you plan in advance ahead of time to determine what kind of tax benefit do you need and what portion of your asset would be most adequate to accomplish what your needs are. So in this example, we're taking half of the business, $1 million, and we're going to go ahead and allocate that to a charitable remainder trust. When we have to do this before the sale, you have to do this before there's anything written on a napkin or anything like that. So this does take some planning in advance. So we're able to transfer part of the business, in this case, $500,000, into a charitable remainder trust. And when the business sells, it can sell inside the charitable remainder trust completely tax-free. The charitable remainder trust is a tax-exempt entity. So really, that's saving in our last example of looking at what the tax consequence is. That's saving you $288,000 on $1 million because we just saved 28.8% of your capital gains taxes. So now, because this charitable trust at death second is going to pass on to a charity or nonprofit, which could even be your own personal donor advised fund, which I call a poor man's foundation, but it can be your donor advised fund or any other 501c3 organization. You're able to get an income tax deduction today for that future gift. The best part is, though, you get to utilize this asset. You're actually able to take income from the $1 million, the full $1 million, because you didn't have to pay taxes on it. And so this example of two 65-year-olds, they took a 6% distribution, which allowed them $60,000 a year of income from this portion of the business sale. And that left them with about a 30-year life expectancy, $2 million. Now, this family didn't want to disinherit their kids. They were concerned that the charity would be getting the remainder of the asset. So we went ahead and purchased a life insurance policy for them. So with the life insurance policy, we paid $300,000 in premiums, which provided them $1 million of life insurance coverage. So when we take their lifetime income and we minus what we paid in insurance premiums, that left them with $1.7 million of lifetime income. The kids, after death second, were able to get the $1 million inheritance, and charity got the $1.3 million benefit, or even a donor advised fund. And the tax savings of looking at this income tax deduction of $275,000 for a person who's selling their business, it's likely, or at least in this range, that their income tax is going to be close to 40%. So that income tax deduction on the year of the sale is really, if we looked at that, 40% of it is $110,000 back in this client's pocket. And they're able to actually utilize this income tax deduction to offset their income or the other portions of tax on the other half of the business that they kept outside of the trust. So with the $288,000 of capital gains tax savings and the $110,000 that they were able to keep from the income tax deduction, they ended up getting $398,000 tax savings. That's money left in their pocket that they can keep working for them.